It's a six-piece, folks. 6 videos up for me to react to. We know the Fed's making moves. Tomorrow we'll speak about what my expectations are around that, what I think is going to happen in the stock market. A rate cut is not necessarily even warranted at this point, says JP Morgan. That's going to be an interesting one to react to. Wow. The biggest single risk for the Fed is to do too much too quickly. Oh, boy. I'm going to try not to lose it at the beginning of this video. That's all I'm going to say about that. Fed has nothing to lose with a 50 basis point cut. Looking forward to reacting to that one. Heyman would be shocked if the Fed cut isn't a half a point. So you can already see the divergence between these folks. Some people saying, well, it's not even warranted, 25. And other people saying, what? We need to go 50. Our base case is for the Fed to deliver a 25 basis point cut this week. This is from Vanguard's global head of rates. You know how much money you got to make to pay somebody a fortune to be your global head of rates? Like, that's an insane position. Rate cut is already baked into mortgage rates. I'm really looking forward to this one because a lot of people assume that since the Fed's dropping rates tomorrow, that's going to bring down mortgage rates. Not necessarily. Mortgage rates might actually go up. Yes, you heard me right. Mortgage rates might actually go up tomorrow, even though the Federal Reserve is cutting rates, and that's going to blow people's minds. So we'll speak about that in this video. Pin comment down there today. I got a free workshop for you guys, stocks to buy now for 2025, how to position your portfolio. Goes over those sorts of subjects. You got to start thinking about that now. We're only a couple weeks away from going into the fourth quarter of the year, so you got to start thinking about how am I going to position for 2025. So that's a free workshop. Goes into that. I'll put that as pin comment. Thank you, everybody, that smashed that thumbs up button, and thank you, everybody, subscribe to the channel. Well over 50,000 subscribers here on the Reaction channel now. Let's get into this.
The fixed income at JP Morgan, asset management, you're still...
By the way, good day for a lot of stocks, especially a lot of beaten down stocks, right? Look at Celsius today, up nearly 6%. Revolve's having a nice day, about 3%. Estee Lauder's up around 3%. SoFi's looking green. Cheesecake's looking green. Wynn's looking green. See a lot of green stocks in... Look at the Dow. The Dow's actually red today. Nasdaq's red as well out there. So, but yet, there's a lot of strength in a lot of the smaller stuff and a lot of the beaten down stocks.
Good to see you. Thanks for joining us. You're unsettled a little bit, I think, about what the Fed is ready to embark on. And I think you'd say 25 makes more sense because inflation, they're ignoring some recent hot numbers as if they've conquered inflation.
Correct. I mean, I think I'd say that a cut is not necessarily even warranted, given that we're not really seeing a broad-based weakening outside of a more reasonable labor market, right? Labor or unemployment rate of 4.3% is certainly well within the Fed's own sort of 5% target, which they consider neutral on unemployment. So we went from extraordinarily tight labor markets to sort of a more normal. But outside of that, you know, this morning, again, another beat on the retail sales, and we continue to see just broadly the economy is doing fine. These rates have not been as restrictive as the Fed, I think, expected at the short end, and making them less so is going to probably loosen financial conditions further, which are already the loosest they've been since before the Fed started fighting this inflation.
I just don't understand why we can't have a definitive answer to whether we're restrictive or not. So someone like you can say they shouldn't even cut. Other people are saying they're so far behind the curve they should do.
It should be a definitive answer. Like anybody that should go through Economics 101 should know this, right? Maybe it's 102, maybe it's 103, okay? Listen, here's the deal. You want to know the Fed's restrictive or not? Look at CPI. You want to know if they're restrictive or not? Look at the Fed funds rate. Right now, we got a CPI 2.5, right? Or somewhere around there roughly. We got a Fed funds rate 5.25 to 5.5. That's extremely restrictive. Now let's say things were flipped, right? Let's say we had a CPI of 5.5, and let's say we had Fed funds rate at 2.5. That would mean the Fed's likely way too easy in regards to where they have interest rates, and they need to up those interest rates, right? Because clearly the Fed should not want inflation at 5.5%, right? And if the Fed's at 2.5, but the other thing you got to factor in is what is the employment market like at that particular time. If let's say the unemployment rate's under 5%, then that would give the Fed all the room to raise rates in that sort of situation, right? Now on the flip side, let's say the unemployment rate was, 8%, then in that situation, the Fed couldn't then raise rates because the unemployment rate's too high, right? So those are things you got to factor in here. But we clearly have an unemployment rate that's going up. There's no debating that, right? Clearly, we've seen a lot of weakness in regards to kind of the jobs market recently. There's really no debating that either. We have a Fed funds rate near 5.5, and we have a CPI at 2.5. So, like, you don't want to just stay super restrictive with interest rates just to stay restrictive. That doesn't make sense, right? So, I mean, I don't think it's that complicated.
25 basis points. Everybody's looking at the same data, and you can come to just completely polar opposite is opposite's enough to say, but opposite conclusions.
I think everyone is looking for what they want to see, but objectively speaking, even on the inflation data, right? When we were sitting here in June of last year and CPI year over year was 3%, and everyone considered inflation moving towards 2%, right? We're sitting here 14 months later, and where is CPI? 2.9%. It took us and by the way, there was a lurch towards the high threes in between there, right? So I think it kind of goes to show what...
Ma'am, CPI is 2.5. What are you talking about? Trueflation numbers have us in the ones right now. The ones. The government numbers are too high, believe it or not. Too high. It's lower than that. And look at GSG. Look at commodities, ma'am. Like, what are you talking about? Maybe her data's outdated. I think she said 2.9. Like, what is she talking about here? Look at commodities. GSG's at 20 right now. Give me a break. Like, this isn't rocket science.
We've been saying all along, which is that we are going to be stuck in this churn for quite some time. And the Fed's own, our star, expectations are moving up, right? From 2.6 in March to 2.8% more recently. And I think that will continue to be the case. So they should move quite carefully here. 25 is probably enough to buy them some time to see some more data. And unless we see really a decisive move towards that 2% inflation, which I think will continue to be elusive for a number of factors, not the least of which is the amount of fiscal spending, which is not going to stop. It's going to continue unabated, irrespective of who occupies the White House.
And they shouldn't worry about Wall Street's reaction, because that will probably be disappointing at this point, 25 basis points.
And if that's really what's guiding them, that's really not the right incentive, right? They seem to have dispensed with sort of price stability, or at least put it on the back burner right now, and they're focusing on the unemployment picture. But again, outside of unemployment, which is simply slightly more normal, you're not really seeing broad-based weakness. GDP was revised.
I don't know what she's talking about. That is pretty self-explanatory here. Listen, gas prices down a lot. Commodities in general down a lot. Rent, you can't go up on tenants in regards to rent right now. You can't. Just about in any major city out there, you can't go up on rent right now. Like, you're pretty much having to keep your rents around the same right now. Or in some markets, rents are actually starting to move down significantly. Shelter's a huge lag in regards to government numbers when they go to calculate CPI. So the reality is on the ground, and you could ask any landlord this, ask any landlord. They're going to tell you in most major markets, good luck trying to raise your rent right now, right? So you don't have that fear out there. In regards to home prices, I'm seeing more and more home price cuts left and right here. Vehicles, if anything, we're seeing deflation there. There's just... Insurance was the one lag that we've kind of had to deal with this year. That goes off next year. You got nothing. And so, we disagree a lot.
The economy's continuing to chug along. There's really no impetus to be alarmist here.
And it's nice to have something in the tank, isn't it?
Exactly.
The economy's always going to technically chug along, but do you want it to just chug along, or you want it to go full speed ahead?
It's a downturn.
Exactly.
So do you... people are expecting 150 basis points, 200 basis points.
Well, that's certainly what the long end is pricing in right now. And so my question to the broad-based, right, industry-wide in asset management context and duration is, what are you going to get from that? The 10-year is already pricing in something like 200 basis points of easing, right? So unless you have really a pretty significant recession, that's wildly overdone. So I would say that that's a trade that's run its course, and you should be moving towards different types of opportunities.
So if you were Jay Powell...
I don't know if she's aware of the Fed lags and that they take 1 to 3 years from when they start cutting or raising rates to really start affecting the economy. Something to keep in mind. If the Fed waits too long or lowers rates too slowly, at the end of the day, we could end up in a massive recession 1 year from now, 2 years from now.
Would you stay right here if you could make this, you'd stay right here and see what happens?
I would stay right here and see what happens. There's absolutely no exogenous shocks to the economy right now. They may come, and you want to have plenty in the tank to deal with it.
You're going to be kidding me. They might come. Oh, yeah, let's wait for the massive recession to hit. Then we'll cut rates. Oh, that's so smart. Yeah, ask them how that worked out in the great financial crisis. What are we talking about here? Oh, my gosh, no. No, you want to get ahead of these things. Otherwise, you end up in a big dilemma. No different than you could have said when inflation was starting to ramp higher. It's like, no, wait until it goes up a lot. And then we'll start raising rates. We all have a lot of moves to make there. Yeah, how did that work out for us? Come on, lady. Come on.
Really nothing pushing him towards making any significant moves here. And isn't this similar to 21, early 22, when they continue to believe that, inflation's transitory? To me, this is sort of like, haven't you learned your lesson? You can't claim victory until victory has actually been achieved, or until there isn't that exogenous shock that requires
So
action.
you don't think we're in the middle of a lag period where the restrictive, if we are restrictive right now, where events...
If this lady was a bear, and I mean a real life bear, I'm not talking about a bear in the stock market, I'm talking about if she was a bear and she needed to go into hibernation, her strategy would be, let's wait until it starts snowing and then we'll start worrying about storing up food. We would have not made it very long, let me just put it that way.
That is going to, you could be overcooking the restrictiveness. That's not, you don't
We
think
just
so?
don't see it, again, broadly in the data outside of the slightly more
Are we
normal.
restrictive at all right now?
Not when you look at financial conditions and how loose they are, right?
Add those in,
yeah. And so you're just not really seeing it. In terms of the consumer, which continues to be strong, you look at Walmart, Target, Costco, right? All of those earnings came in fairly strong. You're just not seeing this broad-based weakness that would necessitate this kind of action from the Fed.
No. Did she just state Walmart as something to be bullish about? Please don't tell me she did that.
All of those earnings came in fairly strong. You're just not seeing this broad-based weakness that would necessitate this kind of action from the Fed.
I wonder what caused it. I think we've all been conditioned.
Maybe I heard things.
How loose they are, right?
Add those in.
And so you're just not really seeing it. In terms of the consumer, which continues to be strong, you look at Walmart, Target, Costco, right? All of those earnings came in fairly strong. You're just not seeing this broad-based weakness that would necessitate this kind of action from the Fed.
I wonder what caused it. I think we've all been conditioned to just love
lower rates
and easing and
absolutely. That's what 15
that's not the
years
real
of
world, though.
Extraordinarily.
Walmart and Costco, we're going to cite them? Come on, man. Come on, stop it. Stop it.
Yeah, that's what 15 years of extraordinarily unorthodox monetary policy will do to a market.
It's just people that have never known anything other than mainlining cheap money into their...
And when they think of normalization, I wonder if they realize that the average Fed funds rate historically has been around, the mid fives. If we exclude the extreme, the 20% extremes in the 1980s, that's 4.6% still. And we are, not that far away from it. So I think even if the Fed continues with cutting, and this is really important, if they get us into the high fours or mid fours, number one, they risk reaccelerating inflation, I think. And number two, that's still very high borrowing costs for a lot of corporate balance sheets that are kind of junk balance sheets that are simply not going to survive. So I think credit volatility will continue, bond volatility will continue, and the fiscal dominance that we are seeing from whichever administration takes over the White House, right, that's just going to continue.
Oh my gosh, this lady wants us to wait till we got 9% unemployment, I guess, to start cutting rates. The biggest single risk for the Fed is to do too much too quickly. Oh boy, I might lose it again.
Former Barclays CEO Bob Diamond, now CEO at Atlas Merchant Capital. Bob, it's great to have you in.
Carl?
Does this morning's print do anything to change your view?
No, I have been for a while slower. As you know, from the beginning of the year, we really saw the fourth quarter as the first time that they would cut. Here we are in September, almost to the fourth quarter. My sense is that the biggest single risk for the Fed is to do too much too quickly. So I'm firmly, as Sarah is, in the 25 camp. I think 50 would be a statement that is inconsistent. But most importantly, I think what they should do is only 25. I think it would be, with the markets doing well, with labor doing well, with the economy doing well, that just it creates the risk that we would reignite some inflationary fears. And then, the worst case here is that, in the near term, we have to begin tightening again. So I'm firmly in the camp that what's correct is 25 basis points. And I'm feeling pretty confident that that's where the chairman and the FOMC is as well.
What do you think?
It's unbelievable. It's unbelievable. The biggest risk is for the Fed to do too much too quickly. Are you kidding me? in all due respect, sir, I can't do it. Can't do it.
Looks like in terms of what a terminal rate will end up being.
You know, it's interesting, two aspects. I was saying to Sarah earlier, we just announced this morning a joint venture with A&D Mortgage, which is residential mortgage space. You know, why is Atlas Merchant Capital in that space? I think there's going to be a turnaround in the mortgage market. We had
these sorts of people are the same people that probably back in like 2021 were saying, yeah, inflation is starting to become in trouble, but you know, the biggest risk is that the Fed goes too much too quickly here, and you know, we don't want that, and so don't raise rates fast anytime soon, right? And we ended up having CPI go to the highest numbers. We've seen it in many decades, right? What do we want next? The unemployment rate to go to the highest we've seen in many decades. Is that what we want next? Like, come on, man. If anything, the biggest fear, the biggest risk is the Fed does too little, too slow. Okay? Too little, too slow. That's the real biggest risk here, sir, in all due respect.
$4.5 trillion in issuance in 2021, $1.5 trillion in 2023. Obviously, rates were a big part of that, Carl. So I think that market is expecting a decline in rates. You know, my own view is that prior to 2008, when we had kind of 1% rates forever, the average funds rate for decades was 4%. So in my mind's eye, if the Fed continues to ease, to encourage a soft landing, if inflation stays under control, then I think the terminal level for Fed funds is probably around 4 and 4.5%.
It's interesting, all the banks getting out of the mortgage business. You're going into the mortgage business.
Absolutely. It's the time to do it. And, you know, 2/3 of all those residential mortgages really are done by the agencies, about 1/3 by banks in the private sector. So 14 trillion in residential mortgages. And it's a small sector that's the banks and the private market. And much like private credit, I think private companies like A&D Mortgage are going to continue to take a bigger slice of what the banks typically have. So I think that portion of it, the portion that goes to the banks, will increasingly go to the private sector.
You're investing in it, or?
Yes, we're doing a joint venture, right? Yes. So, you know, how can we help them? I mean, they've been doing this for 20 years. They're fantastic at origination. We can help them with the bond buyers, so securitizations, expanding the list of buyers.
I mean, gosh. Fed has nothing to lose with 50 basis point cut. Thank you.
Eased by 1/4 point, but that they have nothing to lose by front-loading cuts and going big with a 1/2 point cut tomorrow. Joining us is Stephanie Roth. She's chief economist at Wolfe Research. So, Stephanie, it sounds like this is sort of I think they'll only do 25, but that they should do 50 kind of thing?
Yeah, I think that's fair. They don't have anything to lose, like you just mentioned. We have rates sitting well above neutral. Neutral is close to 3% in our view. So they have a lot of time to be able to cut rates. So if they go 25 or 50, probably doesn't matter, because the important thing here is they're starting off the cutting cycle, which we all know they should be able to do. And the economy is starting to weaken, and they don't have to worry about the inflation side of it.
No. Wrong. Listen, if they start out with a 25 cut, okay, and then let's say in November they go 50 at that point in time, right? Because they see more, damage in the economy and inflation continues to come down. Then it starts to look like, ooh, what are you starting to see? You seeing problems out there? Or let's say they go 25, and then they bump it up to 50. Now all of a sudden it's starting to give the image that, oh, you're behind. So now you were doing 25s, but now you're doing 50s, right? They have all the positioning they could ever imagine right now to go 50 right now. Go ahead, do it. You're in the position. You're behind. Everybody knows you're behind. I don't say everybody. Anybody that knows how to read the data knows the Fed is behind. The Fed should have already started to lower back in around March, technically. So everybody knows they're behind. Go 50. You don't want to end up in a panic mode where next thing you know, let's say they start out 25. Oh, we don't want to do too much. Then all of a sudden they bump it up to 50. Then they bump it up to 75. The market's going to flip. The market's going to be like, hard landing, it's coming, we're donezo. It's at the end, right? You can't end up in that situation. Start out 50. Do another 50. And then if you want to bring it down to 25, then it looks like, oh, okay, everything's really good. Like, then you can make that decision at that time. But the last thing you want to do is start out too slow, and then next thing you know, you're doing 50s. Next thing you know, you're doing 75s, like they had to do in the rate, because that's what freaked the market out so much in 2022. Is all of a sudden they started out 25s, little baby rate hikes. Next thing you know, it was 50. Then it was 75, 75, 75. And that's when the market was freaking out in 2022. And that's when you saw all those tech stocks falling 40, 50, 60, 70, 80% in less than a year. From where those stocks were priced in the fourth quarter of 2021 to where those stocks were priced in the fourth quarter of 2022, you saw some of the best tech companies in the world fall 30, 40, 50, 60, 70, some even 80% peak to trough. Historic losses. That's what happens if you're really going to freak things out. And that's what happens when you have to all of a sudden go from small moves to like big. Then people start to flip out. And the difference with this one is it won't just be the market will flip out. We'll get an actual legit big recession if that ends up happening.
Now it's all about the employment side. And whether they do 25 or 50, at least they're getting started.
But you got to keep in mind the consumer is in a lot weaker place now than they were when we went into the rate hike cycle. And so now if you're talking about some sort of a situation where, let's say the Fed freaks the market out, you start getting stocks to crash, next thing you know, you start getting companies to do major layoffs. I'm telling you, the consumer's not set up to weather that storm like they were in the 2022 storm, which would end up meaning essentially big problems for the actual underlying economy.
This is that, they do the 25, but it's a really, really tough call at this point.
Steve, I think they should go 33 and get rid of the range. And they go to 5 on the no more range. They just say we're cutting to 5% and you're welcome.
Why 33 though? And not like, why 33? Why not 37.5? I'm a little confused.
Well, with a person with as many kids as you have at home, the idea that you're looking for compromise and to make everybody happy does not surprise me.
If only it worked like that.
I also did that as the middle child in my family, looking for compromise. But in any event, I think the key is going to be 25 with a forecast for more to come. It'll be interesting to see if they forecast a full 100 for this year. That would be something of a salve to the market if they only get a 25, and what they forecast for next year. So those dots are going to be an important part of the communication, as will the statement. We'll see how aggressive the Fed.
The dots will be important for the market to look at, but just be honest, the Fed has no conception or clue where they're going to be moving rates 6 months from now, 12 months from now, 18 months from now. That is something we know factually. Ends
up forecasting in the statement, which I like to follow very carefully, because as much as anything, that's a reflection of what the full committee can get behind. And speaking of the full committee, there's an issue. I'm interested in our guest view on this, whether or not the chair would have unanimous support on a 50.
Stephanie, what do you think?
Yeah, I think it's very possible we'll see, a dissent or two if they go for the 50. And that's the thing, is it seems like Powell is supportive of the 50. Perhaps that's some of the news stories that we've seen over the past week or so is kind of reflecting the leadership's view. So it seems Powell's probably in support of the 50, but is he going to get support of enough folks that they can actually go through with the 50, which is why we ultimately are calling for the 25, just because it's going to be difficult to get enough of a quorum. So base case is that they'll go with the 25 and they'll get everybody on board. If they go with the 50, it's possible they'll have some dissents along the line.
Quickly, I want to bring Rick in a second, Stephanie, but were you struck as I was, or am I missing something, that the retail sales report comes out, not only is it, we can talk about the consensus, but we all know the whisper was that it was going to be really weak. I've heard people talking for 3 weeks about how they were concerned that this retail sales number was going to be weak. The headline, I think, was up 0.1 from July, which was decent. The core was up 0.3. So as I understand it, the GDP sort of gauge that puts GDP, like Steve was saying earlier, 2.6% annualized for the third quarter. I think to myself, well, clearly this is going to make the case for 25. I go and I ask my team for the market odds, Steve's team, and they've risen to 65% for a 50. What am I missing?
Yeah, I mean, so what we've seen over the past number of months is that the credit card data, which a lot of people use to help forecast what's going to happen in terms of retail sales, has been understating the print. Perhaps some of it has to do with immigration, and folks who are not on traditional credit cards are are spending, and that's lifting the print to some extent. But we've seen the credit card data underestimate what's going to happen. So we got a decent consumer spending number, which has been the case for much of this year. Consumer spending has been tracking well above trend. The market is just looking for this 50 basis point cut. Whether or not we get it, maybe it doesn't matter so much, because if they do a 25, they're going to do it dovishly. If they do a 50, they'll do it hawkishly. So perhaps there's just too much emphasis on this debate between 25 and 50. But what we're seeing is a consumer that's kind of holding in okay. And our base case is the labor market is actually okay too. So realistically, that's what a soft landing looks like. And it's going to be up to whether the 12 people in the room who are voting are going to be in support of this 25 versus 50.
Yeah, that's an interesting wrinkle.
So yeah, either way the Fed cuts tomorrow. Let's say they go 25. Well, each side's going to have an argument, right? If they go 25, you know what the bulls are going to say? The bulls are going to say, hey, bottom line is we started a cut cycle. That's good for the markets, right? That's what they're going to say. Bulls are also going to say, hey, they only did 25 because they know the economy is so incredibly strong, right? And so we're getting a cut cycle into a very strong economy. Boom, we're booming, baby, right? Now, if they do 50, right, then the bears are going to say, oh, they did a 50. Well, yeah, that's a big rate cut for you guys on the bullish side, right? But they're doing that because they're really fearful of what's going to happen with the economy. And they feel like they have to cut 50. And so that's bad news, right? So whichever way the cut happens tomorrow, whether it's 25 or whether it's 50, the bulls and the bears are going to ultimately have arguments to be made whichever way they go. And that makes it tough to really get a decisive way in which the market's going to move really tomorrow. And so a lot of people are expecting either a massive drop or a massive... I wouldn't trust either move. If the market dropped a ton tomorrow or if the market went up a ton, I wouldn't trust either move, to be honest. And the reason being is there's going to be such a strong argument made on the other side that all of a sudden the market could flip the other way easily.
The retail sales as it relates to immigration, I hadn't heard that. Obviously, there's a lot of areas we're looking at to see if there's either seasonal distortions because of immigration unauthorized or so forth. And it's just a sort of data point I think we need more clarity on. Steve, what were you going to say?
I was going to say that there's fast money and there's slow money. Fast money cares a lot about the 25 versus 50, and they're going to come in tomorrow and express their pleasure or displeasure. I think from a long-term investor point of view, follow the guidance, figure out where the Fed is going, and let's listen to the answers from the chair about why they're going there and how far they have to go. Those are the things I think that are going to be ultimately determining bond and stock prices over time, apart from the gyrations you're going to get at 200001 when that statement comes out tomorrow.
Yeah, and then the presser, we'll see how that changes things as well. It's going to be an interesting afternoon. But thank you both, really appreciate it, and we'll let you go for now. Steve Leisman and Stephanie Roth.
Which is like, the economy's buzzing along pretty well. You used to be looking for a recession, and last week you said you had to make the tough decision to flip it. Why?
Because the economy's buzzing along. And one of the things I pride myself on is being practical. I'm a bottom-up. I listen to people. I look where I am, and I walked over here. It's buzzing along, and the system's awash with liquidity. The market's already at a new high. The Dow hit a new high yesterday, so let's not. And then I've been pushing my recession forecast out.
Yeah.
And my friends have been laughing at me.
A lot of people have.
They say, Ed, you'll be right eventually. We'll have a recession someday.
It's true.
So I had the fourth quarter down, and it's not going to be down.
So just be clear, you said you kept pushing it out. Is it just gone? Soft landing, here we come. No recession in view.
That's correct.
Okay, so no recession in view. Then Ed, tell us about this 25-50 cut debate. Where do you land on it if a recession's not on its way?
So this is something that freaks me out. When people that have been calling for recession say there's no recession in view, that's when I start to get fearful. That's when I start actually saying, what's going to happen here? Let me start looking at some hedges here. Like I start getting suspect when the recession crowds start saying, no recession. We're just wrong on this.
If they don't do 50 tomorrow, I'll be shocked. I've been at this a long time. And
I wouldn't be shocked. They screw up all the time. The right move to make tomorrow is 50. The Fed a lot of times doesn't make the right move, so I wouldn't be shocked if they made the wrong move, to be honest.
They have a system where they use people at the Journal or the Financial Times to communicate with us, with you, Matt, about what they're going to do.
I wish they would use me for that, Can you get them to call me?
You're too expensive.
That's the problem. Yeah.
So they've said pretty clearly they're going to do it, but at this point, the way I cut things, whether they do 25 or 50, if they do 25, they'll lather it on pretty quick that they're going to do more later.
Yeah, so you have now a pretty optimistic call on the economy. Why does the Fed need to be, I guess, Gabriela Santos said they're going to calibrate with this 50 basis point cut, but did they really need to be a heck of a lot lower? Does 5.5% seem super restrictive to you?
Well, this gets into my old self. Yes, inflation is probably down to 2. I'm exaggerating, but let's say it's down a lot. And the yield curve's been inverted for the longest time ever by a lot, almost a year. And money growth is about 2%, which is pretty skinny.
Yeah.
And all this stuff leads by a year or two. So if they want to make a difference, they need to look ahead. And so I think they've sort of taken a few pages out of my playbook, free of charge. And so they're making a preemptive move here. I don't know if there's any politics involved. Do you think?
Do you think? I mean, we have Elizabeth Warner coming out saying you should go 75 basis points. Is there going to be a political element to this decision?
What do you think? I mean, what they do now, what they do now couldn't really change the economic landscape.
No, of course not.
But if the market was going to go down, this could change that.
No. No politics involved in this one because it just doesn't make sense. Like, it's not going to change anything in the economy before the election. No one even cares about, such a small percentage of the population even cares if the Fed lowers or raises interest rates. And the stock market's already at all-time highs. So if it was some situation where the stock market was crashing and then they're like, crap, we got to lower rates right before the election, okay, that's a different subject. But when everything's already at all-time highs, there's nothing there. Our base case is the Fed delivers a 25 basis point cut this week.
Fed meeting in years, we know that we are going to get into a position where the Fed is actually starting this lower rate cycle. How much does it matter what they decide today in terms of whether it's 25 basis points or 50?
As you say, I think the decision is very, very close. Markets are priced a little over 50% chance of a 50 base rate cut this week. Our base case is that the Fed delivers 25 basis point cut this week. We think the combination of economy that maintains decent momentum and also the Fed preserving some optionality in case the economic performance diverges in the coming months. We think there's a strong rationale for them delivering 25 bips, although we do understand why there are others that think that 50 bips is the right option. If you look at the combination of where real policy rates are and the clear slowing we've seen in the labour market over recent months, it's understandable that with policy rates as tight as they are, 50 bips should be an option the Fed is considering.
When you say you think 25 basis points make sense in case the economic case diverges, you mean in case inflation comes back?
Or in case we get either weaker performance in the months ahead, that gives the Fed greater optionality to speed up those pace of cuts. But similarly, if we also see growth maintain decent strength, we did see a pickup in inflation, or we saw risk assets really perform very strongly, it would get the Fed greater optionality as to how it chooses to pursue policy decisions in the months ahead. A 50 basis rate cut this week markets would certainly run ahead and think the Fed was going to deliver further 50 basis point rate cuts at subsequent meetings.
Yeah, and there's been a lot of talk about that, how it would spook the market if the Fed goes 50 basis points because maybe people will wonder if they know something that we don't. I almost wonder, though, if the market would be spooked at this point if the Fed only goes 25 basis points because the 50 basis points almost being baked in at this point, more people expecting that than not. If it's not delivered, then the narrative begins that the Fed is doing this too slow, just like they raised rates too slow on the way up and let inflation get out of control.
Yeah, the Fed has tended to deliver over recent cycles what the market has got priced. And that's why I think the articles over the past week or so we've seen putting forward the case for 50 are very interesting. You go back to June 22, we had a Wall Street Journal article that clearly guided the market that the Fed was going to be hiking rates by 75 basis points. Now, I think the articles we've seen over the past week are different. They are much more, I would interpret, as opinion pieces setting out the case for either 50 or 25. So I don't think that they're giving such a clear steer. I think you're right to say that if the Fed delivers 50 bips this week, the market would interpret subsequent 50 bip cuts are likely. I do also think you're right that a 25 basis point cut, and if we then subsequently see weaker data, you could get a more adverse reaction from risk assets as they would fear the Fed risks falling behind the curve.
Is there any reason that the Fed...
You as a long-term investor, all this talk about 25, 50, how much are they going to cut next time after this? And is the Fed going to come out super dovish or hawkish? All these sorts of things, right? You as a long-term investor, what do you do in a situation like this? I'll tell you what you do. You buy great companies that are looking like they have very attractive pricing on them, and you call it a day. Because all this is fun to kind of see what's going to happen, and it's all very entertaining. But as a long-term investor, you're going to stay very focused out there. I don't care if they cut 25 or they cut 50, I'm going to be buying stocks, right? I'll be buying stocks on Friday. Next week, I'm going to do the same exact thing. I'm always looking to, even with all the drama going on, I'm always looking to add to great companies that I love for the long term, right? If I love Nike, I'm going to buy some Nike stock on Friday. If I love Wynn at $80, I'm buying some Wynn. I don't care if they're cutting 25, they're cutting 50 this week. If I love Meta, I'm going to buy some Meta. If I love this, at the end of the day, Palantir, Elf, whatever. If there's a great company that's at an attractive price that I say, over the next 5, 10 years, this company's going to likely produce this much and I'm getting it for this value, it's a great deal, I'm going to pick up those shares, okay? Now, from a hedging perspective, if I think they're making mistakes and I think they're going to cause us problems, I might hedge a little heavier. I might hedge into certain positions that I wouldn't have hedged in, right? I might make some decisions as far as that goes. But in terms of my normal buys, no. You gotta make your usual weekly buys, monthly buys, however often you buy, and call it a day.
care what the market reaction is? I mean, within reason, you're talking about 25 basis points, not that big deal of a deal one way or the other. We talk all the time about how politicians shouldn't be allowed to bully the Fed, should investors.
Mm-hmm. Yeah, I think that's right. But I also think even if the Fed was to deliver 25 basis points this week, it would come with clear dovish messaging, in that if we did see a further deterioration in labour markets over the coming months, the Fed would stand ready to quicken that pace of rate cuts. So I think you're right from that perspective. 25 and 50 isn't the be-all and end-all this week. It's more about the messaging around the future policy trajectory and how the Fed would respond to economic surprises.
All right, so give us your outlook on where you think rates will be at the end of this year.
Yeah, we think bond markets are attractive here. We think real yields at 1.5% at the 10-year point still offer investors good compensation relative to where we've seen real yields over much of the past decade or so. We think that corporate spreads or corporate fundamentals are sound, and we think the Fed has your back in terms of risk taking. So we are seeing strong flows into bonds, and we think that yields can still fall substantially further if we were to see the economic environment deteriorate, recessionary risks to rise. Fixed income still offers a strong ballast within an overall portfolio context. So we still think yields can fall further if we were to see economic conditions deteriorate further, and there's good rationale still to owning fixed income at these levels.
Roger, we mentioned a little earlier that 3 Democratic senators, Senators Warren, Whitehouse, and Hickenlooper, I believe, wrote a letter to the Fed saying that they should cut basis points by 75 basis points at this meeting. Is there an argument for that in your view?
Yes.
Real policy rates at 3% are certainly very high relative to where we've seen in recent decades. That's why the Fed is set to start easing this meeting and will continue to cut rates at subsequent meetings. But right now, we're not seeing an economy that's on the verge of tipping into recession. So I think the Fed would be well guided to maintain some optionality, proceed gradually, but can always quicken the pace if we do start to see economic conditions weaken.
There's an argument for 300 basis points of cuts. 300 basis points of cuts. Just to be quite frank, right now, if you got CPI at 2.5, which once again, that number's too high, it should be lower, but you got CPI at 2.5, and you got a Fed funds rate at 5.5, right? You technically could cut 300 basis points. Are they going to do that? No, because that would they don't make decisions like that. They want to be a gradual, like we're going to do this, do this, do this. But and even if people were to look at that and say, oh, those people are just doing it because they think it's going to win the election. No, once again, it's not going to win the election. Markets are already at all-time highs. And there's 1 to 3 year Fed lags. So even if they cut 75 basis points, it does nothing to help the election out. Absolutely nothing. And plus, Harris may not even win. So let's say, Trump wins. Okay, so now Trump's in office, and you just did a 75 basis. It doesn't make any sense, right? They I would say probably feel like they should cut 75, and like I said, they should actually cut 300 basis points. But we know that's not going to happen, right? Rate cut. Now, this is a very important educational video here. Very important. If you own a home, or if you're ever going to own a home in the future, and you want to know kind of more about mortgage rates, this is a very valuable clip here. It's from the Rocket Company CEO explaining how mortgage rates are actually calculated and how mortgage rates might actually go up depending upon how much they cut tomorrow. This is very important and very educational. If you're still watching the video at this point, 40 minutes deep, and you're watching this educational portion, let me know in the comments. Say something like, I'm here for the Rocket Company CEO. Say something like that, and I'll know, okay, people are still with me at 40 minutes in for this educational piece, because I bet you 99% of Americans, no clue how mortgage rates work. 99%. So once you watch this video, you're going to be in the 1% that actually knows how mortgage rates really work. You're special.
Here, shares are doing well lately, near about a 3-year high, I think. Why could a rate cut make mortgage rates rise?
Thank you, Kelly. It's great to be here. I think the good news is today we've got a great rate environment for clients who are really looking to jump into the business. And so a lot of that rate cut is already baked into the market. And so that's the reason that you see the interest rate environment where it is. And, the good news for us is we're really focused on meeting our clients where they are. And really, we've seen an increase in demand for both refi and purchase. And the good news is, for those folks that have been waiting on the sidelines, kind of looking to sort of jump into that home purchase, this really helps them to kind of lock in a rate today.
I look at 6.1, and we all know when that rate goes below 6, the headlines are going to be everywhere. The buyers are going to be a little bit more excited. Maybe not a huge amount, but a little bit. If they go 50 tomorrow, that could certainly. And I know what you're talking. We always talk about the price off the 10-year. So it's not the overnight Fed funds rate that really matters. And maybe you know the formula exactly better than I. It's kind of the 10-year yield plus or minus a spread, which is historically wide right now.
Yeah, I think, look, a 50-point would be a really nice thing for the rally of the market. I think we'll start to see demand obviously increase as well. But that's going to be kind of the big question as the Fed weighs in terms of, unemployment versus inflation. The thing I would share is, over the past 2 years, we have over 6 million loans that are out there that are over 6.5% on the interest rate. And so the good news is, a lot of those clients are sort of have the potential to be in. Okay,
so right here, very important. Tomorrow's cuts baked into mortgage rates already. So a lot of people think because the Fed's going to cut tomorrow, it's going to change mortgage rates in a substantial way. So let's say they cut 25 basis points. A lot of people assume that means 0.25, the mortgage rate's going to be down tomorrow. It doesn't work that way. It doesn't work that way at all. Mortgage rates might go up short term with a 25 basis point cut. So if the Fed only cuts 25 basis points tomorrow, you might actually see mortgage rates go up, believe it or not. A 50 basis point cut could spur mortgage rates to go down a little bit in the short term, but don't expect us to go from, let's say, 6.11 down to, what would that be, 5.61. That's not the way this works, okay? So this is very important to kind of keep this in mind, folks. Very important.
And we're happy to serve them. This is a big focus for us. We're growing our share in any rate environment, whether, it's the previous conditions or what we're seeing now. And so we're focused on increasing the scalability of our platform, meeting our clients where they are, and delivering an incredible AI-powered experience that really reflects who Rocket is.
If spreads were at historical levels, the mortgage rate would already be in the 5s, wouldn't it?
Well, I think that's one of the things, you've got a lot of folks out there that have, interest rates that are between 5 and 7%. And so the good news is, as the markets rally, we just have an opportunity for many of those folks to come to Rocket, look at a rate and term refinance and really be able to have an amazing experience.
A lot of traders have been looking for kind of stocks to play on a rate cut, and Rocket is a name that often gets mentioned. My question.
Yes, I brought up Rocket what was that? I think it was the end of 2022, and I said first half of 2023 could be a great time to get in Rocket. You're going to be ahead of rate cuts, but the stock will already start moving before. And I bet you Rocket has been an absolute rocket ship here. Let's pull it up. So so this is back in 2022. First half 2023, stock is kind of in that $8-ish range, $7, right? And by the time we get to now, it's 20. It was such an attractive opportunity there, right? You may say, why would you want to play a stock like this, let's say end of 2022 or going into 2023, when rate cuts still aren't coming for a while? It's because people are going to play it ahead of that, right? And so that's exactly what we saw play out here. So you could go back all the way to October, stock $7, and it's basically about tripled now at this point in time, from 7 to nearly 21 in a short amount of time before the rate cuts even happened, right? Just because people say mortgage rates have already peaked by that point in time. And so, oh man, yeah, it was an attractive, I gotta say, it was a very attractive trade. I should have probably done something there. It's just, it wasn't one of those companies I really want to hold long term. It's just, I looked at it and I'm like, this could make a lot of money short term. But anyways.
How much delta is there? Sure, it's a catalyst. Sure, we've got buyers and refi demand kind of coming in at the margin, but it's incremental, isn't it? It's not transformative.
Our focus really, we had our Investor Day event just last week, and the two big things that we focused on with investors are our long-term growth targets. We want to double our purchase market share from 4 to 8%. We want to significantly increase our refi market share from 12 to 20%. And the reason that we feel confident in that, which would lead to about $275 billion in production in the year 2027, is the power of our technology investment. We have something that we call the Rocket Super Stack. It's composed of 4 layers. It's the origination servicing flywheel that allows us to serve clients for life. It's the multi-channel experiences that we deliver that allow us to be wholesale, direct to consumer, and work with enterprise partners. It's the proprietary AI-driven investments that we've made on top of that, and it's a brand that clients trust. And so that's one of the reasons that we have confidence in our ability to grow kind of in any market.
Although, I think about your ads from a few years back, which, I always enjoy.
So, something important here is if we can get mortgage rates to go in the 5s, it's going to be very helpful. I don't know if it's necessarily going to be super helpful to the overall real estate market in terms of like everybody's going to go out and buy homes like a lot of people are thinking is going to happen. But one area could help a lot if we get mortgage rates to get in the 5s here in the next 3 to 6 months is all those people that have signed off on mortgages the last few years in the 6s and the 7s, right, will then be able to refinance at, let's say, a 5.5% rate or 5.75 or something like that, which at the end of the day just puts more money in their pockets. It might be $100 difference a month, right? For some people, it might be a $200, $300, $400 difference. For some people, bigger mortgages, it could be actually like a $500+ difference each month, right? Which, once again, is just extra money in your pocket that you can go then spend in the economy, which is good. So that's just something to kind of factor in there. But I hope you enjoyed that piece there here at the end because that's important to understand how mortgage rates actually work here, folks, okay? Pin comment down there if you're looking to access my brand new free workshop, Stocks to Buy Now, how to position your portfolio for 2025. Valuable video there that will be pinned comment. Can email it over or text it over. Much love and have a great day.